Well, here we are, episode 15 of the What Do We Do podcast here on site at Great Lakes Wealth. Kyle Bogey, Dewey Steffen. How many cups of coffee is that for you today, Dew?
This is definitely more than two. I'm thinking 3 or 4.
You see, you and I are very similar in that way. Okay, I will drink coffee all day, all night. It does not matter the time.
I don't have any issues with the caffeine, if that's what you're talking about.
No, it's great.
Yep. I love something, I guess, warm, just the warm drink, right? So give me a warm cup of coffee, and I'm in a good spot.
Well, I'm glad you had plenty of coffee because I'm going to take you to task here a little bit on episode 15 of the What Do We Do podcast. And again, we appreciate you guys downloading, subscribing, sharing. Please continue to do so. And if you do want more information, please go to greatlakeswealth.us to learn a little bit more about Dewey and his team. But an interesting episode because we go back to one of the first episodes that we did of WDD, and there was a quote that stands out, and it's coming to mind right now as we are about to enter the fall, and Labor Day has come and gone, and I believe the quote was, "Sell in May and go away." And in most years, I think that 100% plays true, right? That's why you would say it.
Seasonal investing. Sell in May, go away, and come back after Labor Day.
But this year, given the incredible circumstances and everything that has gone on in our world, just an unprecedented pandemic that no one could have possibly prepared for, that quote, that strategy, whatever you want to call it, that trend, I guess, that we've seen over the years, it really didn't play out that way.
Not even close, Bogey. September. So Labor Day was yesterday, right? So we are past Labor Day. Technically, with that seasonal investing strategy, you don't invest until October. So we have a few weeks, knock on wood, there's nothing that makes the strategy right in the next 3 weeks. Otherwise, we have some problems again. But no, couldn't have been further from the reality this year. The S&P, I think, has been up every month since April.
And just unbelievable. And you look at, all the percentages each individual month. April, 12.7% it's up. May, 4.5%. Is this one of the more insane, 4 months or so, 5 months that you have ever dealt with throughout, your entire career?
This whole year since the pandemic started has been unprecedented. This is nothing like 2008. This is nothing like 2000, 2002. This is certainly nothing even like 1929, going back that far. The Federal Reserve has put a floor in this market, and they call it the Fed put, but the Fed and the other government bodies that be have said they will do whatever it takes to keep this economy above water. And the economy may barely be surviving, but their policies have taken the stock market from the depths of despair back up to the atmosphere. How about that?
Is it as simple as that? Because, we're still seeing unemployment numbers that are at a high rate based on everything that has gone on. We're still seeing people not really being able to leave the house as much as possible. Restaurants, 50% capacity. Airlines removing seats, not selling as many tickets. How is it that we haven't seen, at this point, nearly as many losses, from February to now? It's almost back to normal.
Well, I don't know what that means, almost back to normal, because you've had thousands of small businesses around the country that have closed.
Well, I meant the market.
So the market.
It amazes me. The market could be as high as it is, but there's so many other things that are going on within the economy.
You got it. So on the surface, because you look at the S&P index, and it's back to an all-time high after dropping, 30% from top to bottom in the first and second quarters, right? Is that what we're talking about?
Mm-hmm, absolutely.
Okay. Well, guess what? If you, according to Credit Suisse, which is an investment bank out there, the tech sector of the S&P, right? Remember, there's 11 sectors of the S&P. Well, the tech sector is the best performing sector on the year, through last Friday, and it was up 27% on the year. Okay, so we have the S&P up on the year. We have the markets, if you will, back to all-time highs. But the leading sector is the S&P is the tech sector. You follow me so far?
Absolutely.
Okay, well that sector is has over 50 stocks in it, okay, but 5 stocks are carrying the majority of the weights in that index. They call it the Big Five, okay, and that is Apple, Amazon, Alphabet, which everyone knows as Google, and Microsoft and Facebook, okay. Those Big Five are up 37% on the year as a group. Follow me there?
Huge.
Okay,
Yeah.
so those 5 are up 37% on the year as a group, and that equates to the tech sector being up 27% on the year as a group. Okay, so that would tell you that the rest of the tech sector is either down or up just less than 27%. Make some sense? Okay.
Absolutely.
Well, if you opine that out to the rest of the stocks in the entire S&P 500, the other 10 sectors that are out there, the S&P would be minus 6% on the year. So you take away those 5 stocks, we're down 6% on the year. It's still, not as bad as it was down in, March, April, May, but certainly paints a different picture than you and I are talking about.
Let me make a connection here. So it would be like a star player on a basketball team, a hockey team, football team, carrying a severely limited roster and leading the charge. Is that essentially what you're getting at?
Kind of similar, absolutely. It's the numbers can be painted to fit the narrative, as they say. The bottom line is the markets are up on the year, and if you have a diversified portfolio, you're not going to be up the same as those 5 stocks, but you're also not going to be down as much as those other 400 some odd stocks. So you need to be diversified is the message there. But also a lot of our listeners, I imagine the majority of their investments are through their 401k or 403b, their retirement plans. And so those would be in, again, S&P 500, diversified strategies. So they're in a good spot, and they're just tracking this index, which, again, is at an all-time high on the year.
Before we take a look at September and kind of start to, move forward a little bit, I'm curious myself, because clearly Great Lakes Wealth does an unbelievable job. You clearly all over it, on top of things. And there's a level of trust. When people are investing money with a certain company, with a certain person, there's obviously a major amount of trust. But in your daily life, in your life here at Great Lakes Wealth over the last 4 months of this volatility, this unprecedented, what has the day-to-day been like? And I guess how do you have experience in this. You've been doing this for forever. You've been in the business. But how have you navigated the day-to-day and managed the ups and the downs? It had to just be a little bit stressful going back and forth.
Well, every day is, I don't want to say stressful, but maybe controlled chaos, if
Yeah.
you will, because the more something goes up, if you are a firm or an investor, which we are and our clients are, that are looking for prosperity and looking for future growth of things or their investments to rise, then this recovery has been fantastic for us all. All investors have done very well, especially considering where they were, at the end of March, right, with the bottom on March 23rd. We talked about a few episodes ago about a golf comparison to having a mulligan. Right, you called it a members bounce,
Yeah.
but as a
Very familiar with those.
Right, so again, we're telling our clients that if it's just the market you're talking about, and you saw your portfolio at the end of March, or you saw what was happening, and keep in mind those Big 5 I just mentioned, they were all dropping like a rock in the first quarter of this year as well. So if you're in a situation where you were anxious then, or panicked then, or scared then, or whatever the word is, now you're at a spot where you got that mulligan. Man, I wish I could just do it over. I would have sold, or I wish I would have, could have, should have. Well, now you can. So that's the simple quote, simple answer,
Sure.
Simple quick answer for you. Longer, it is, your investing should be a plan. It should be a long-term, goals-based financial plan. So what are your goals? And again, we're not talking about quarter over quarter. And again, when you're talking about Warren Buffett, as we talked about in the last episode, and his birthday and some of his quotes, one is be fearful when others are greedy, and be greedy when others are fearful. So in March, if you are rebalancing or taking advantage when people are fearful, be greedy. It means put some money into the market as much as it makes your stomach hurt, as much as the logic says, I'm not doing that. I'm going to wait. I'm going to actually pull out now. You're not supposed to sell out when you're fearful. You're supposed to be greedy when you're fearful, right? So the other one is maybe now everything's high. People are kind of not just taking it with a grain of salt, and everyone's greedy. Maybe it's like, hey, I want in on Tesla. I want in on DraftKings. I want on this pen gaming opportunity, right? Everyone's talking about how, I'm going to do this. I'm going to buy this. I'm going to do this. I'm going to buy this. I've been doing this a long time, Bogey, and I'm telling you, that's erring on the side of greed, not fear. And so we are absolutely taking measures to protect against the market coming down, our investments, rebalancing, or if you will, reverting to the mean, as we call it. So, and every day is a new day. This is a brand new climate with what the Fed is doing with these unprecedented measures. So we believe the market can go higher. We've also said in the past a wall of worry. It keeps going higher with all that's going on. Upcoming now will be third quarter earnings reports, right, in October from the third quarter ending September 30th. And then guess what's right around the corner in November, Bogey? You got an idea?
I think somebody's going to be voting for something, or, something's going on.
You got it. The U.S. national elections, baby. And there's a presidential election and also Congress and a lot of local elections. So this is going to be a significant event that leading up to it, there'll be, again, news headlines. There'll be information, again, from companies. The Fed, just a week and a half ago now, talked about a new change in their posturing and trying to get an inflation factor involved, which they want to, usually they're trying to keep inflation under control, meaning keep it kind of down. Now they want to raise inflation up a little bit, get some prices going up. Wall Street's like, what? What are you talking about on top of all this other stuff going on? But we get it. So when when the directives change, we change. And so sell in May and go away did not work this year. We are not a trading firm, and so again, that's just an old adage out there on when the market has a seasonally hot cycle and a seasonally low cycle. But all that to say, historically speaking, September is absolutely the worst of the 12 months of the year.
Yeah, and I want to get into that, but again, just remarkable stuff to stay the course. You and your team, and everyone here at Great Lakes Wealth, to just navigate through all of that really is remarkable. And if you want to find out a little bit more information, there's a ton of data, brochures. You can answer questions. Just go to greatlakeswealth.us to find out and maybe educate yourself a little bit more as well. Hey guys, it's Bogey. I want to take a second to talk to you about Dewey Steffen and his excellent team at Great Lakes Wealth. Look, do you feel overwhelmed with managing your assets in today's financial world? How could you not? I mean, think about the times we're in here in 2020. Do you want financial freedom? Great Lakes Wealth offers Wall Street solutions with Main Street values. They sit down with you to develop custom financial solutions utilizing all of your assets, even your 401k. We build the future you want based on your goals and your dreams. That's what Great Lakes Wealth is all about. Thinking about you, thinking about your family, and thinking about your future. Simply go to greatlakeswealth.us to schedule an appointment today. They offer better investments, better service, and a fee-back guarantee. That's right, a fee-back guarantee. Okay, a fee-back guarantee. I'll say it one more time for you if you didn't hear it. Your road to financial freedom starts at greatlakeswealth.us. Please visit greatlakeswealth.us or simply give Great Lakes Wealth a call today. So you mentioned September. And, historically, one of, the worst months, of the year. Is that what it looks like is going to be, again, the case this year? Again, this year has been so different and so odd. Is that really expected to be the case, or is it going to be a little bit different this year?
Bogey, this would not be podcast 15 if I didn't have a quote for you.
Oh, okay. Love it.
Have you heard of the Stock Traders Almanac?
I have not.
Okay, well, there is a publication out there called the Stock Traders Almanac, and it comes out every year. And so in the Stock Traders Almanac 2020, the Almanac says September is when leaves and stocks tend to fall. On Wall Street, it's the worst month of all. Okay? right? I even got Sully here behind the production tools laughing at that one. So that I thought would be great for this. So September is, again, the worst month of all, according to the 12. We actually don't think, from our perspective, that it's as significant as the historical data shows. We do believe that the market is, overvalued. We do believe that the market should have a period in here somewhere where prices come down. We recognize that the entire world of stocks are not at all-time highs. We mentioned about the big five, etc. So we are looking at September, through a microscope, if you will, and trying to find opportunities, and also make sure that we stay out of harm's way as best as we can here. But there's a lot to talk about. And just because the stocks might have their worst month ever, maybe there's other investments out there that have their best month ever in September, right? So there's all kinds of ways that you can manipulate your portfolio, or that you can serpentine through the wild investment world of September 2020.
So you teased us there with some, potential stocks that could go up, some could go down over September and October, leading into what's going to be a massive, November. What are some of the things to look out for, I suppose, in September and October here before we get into November?
Well, we do look back to a prior podcast when we talked about gold and precious metals, right? And so if you look at the data going back to 1987, gold has posted a positive return in 21 out of 33 Septembers. So when you're talking odds, you basically got a 2/3 opportunity with gold going up in September, no matter what else is going on. Make some sense?
Why specifically, I guess, would that be?
Well, we'll just talk about that again, because things can be seasonal, and investments move in different directions. Mm-hmm. All the reasons why gold did well in the past would be the same reason that it went up, that maybe the stock market goes down, right? Different data for different times. Sure. But as it relates to now and this year, we talked about the value that gold may have as a hedge against other events that may happen. Again, refer back to that prior podcast. Mm-hmm. Also go to our website, greatlakeswealth.us. We have a video on gold and some information about gold as an investment, right? But so with that, with what the Fed even said, again, around 10 days ago, of increasing, its inflation mandate, if you will, gold is usually a hedge against inflation. Gold did surpass 2,000 an ounce last month. It's been volatile lately. We're not saying it's the investment du jour, or the, get out of stocks and into gold, but we've talked in the past, it's a very non-correlated investment. And in the month of September, we don't know what's going to happen with stocks. I could argue that they'll continue higher through the election. Depends on what the Fed does and other things. But just as a statistic, gold has been a shining beacon in 2/3 of the Septembers since 1987.
Okay, so what other things, I guess, should we be looking out for? Gold may be one that has historically done well. Are there any others that maybe have gone the opposite, way that we should be leery of?
Well, just again, stocks in general, when they say they've had the worst month of the year, it's actually, if you go back all years to 1896, if you're talking about the Dow or whatever, the 1940s with the S&P, it's not like it crashes 10% or something like that. It's down less than 1%, okay? But there are years where it has been down 5 or 10%. But if you add up all of the years and then divide by that number of years, the loss, is between 0 and 1%, 5, 6, depending on what year you start. All of the other years are down, less than that, or mostly of them are up some percentage as well. So, no, there's nothing else that is, an extreme, opportunity that's just right in your face. You just may want to sit on some cash. You just may want to, again, talk to your advisor, talk to the professional that you work with to have an understanding of what you're trying to accomplish, right? Sometimes it's to make a killing. Other times it's to not get killed.
What, I guess, anything else that you would want to add about September and October and things to just kind of pay attention to, as we head into that critical November?
Well, we're going to be looking again at earnings of companies. In the month of September is when they'll be wrapping up Q3, and then they'll report kind of towards the end of October, and that'll be right in the heat of election season, right? It's
gonna be crazy.
The debates will be have happened if they're happening. Who knows? There's
virtual debates.
I mean, what about this? Have you heard of mudslinging? I mean, that's what they do, right? But I don't even know who slings mud. I mean, I guess just call it what it is.
Just throw it. That's all.
Yeah.
Throw it and see what happens. I think that's what's going to be going on.
Right. So we'll be paying attention to what happens with COVID-19. We haven't talked about that specifically, but as the seasons change, a lot of the science says, that with the cold weather, it may come back, or just with people back inside more than outside, whether that's a state by state or country by country. We're going to definitely be looking at how that impacts the economy locally, as well as nationally, as well as globally, but also the idea of a treatment, of a vaccine. Hello. You catch a vaccine announced next week or the week after, and this market doesn't care what month it is, it's going higher, right? So that's something that we're paying very close attention to, and I guess that would be one sector, the S&P, the pharmaceutical or biotech sector. That's something that you could pay attention to as well.
You mentioned the Feds obviously have been doing everything they can to keep the market at a reasonable level. There also, though, was a virtual conference apparently in Jackson Hole not too long ago. Is that correct? And a new policy has been adopted?
Yep, that is it. That's what you're talking about. The Jackson Hole Economic Forum is where every year the President of the Federal Reserve, the Chairman of the Federal Reserve, I should say, and a lot of the economic thinkers get together and talk about economics, etc. And this year it was held virtually, so it was still the Jackson Hole conference, but you didn't have to be in Jackson Hole to attend. And Chairman Powell did said that the Fed would be willing to let inflation rise, quote unquote, a bit above 2% for a while, and it would now target an average without moving to tighten policy. So that also lets us opine that the Fed will likely keep rates lower for a longer period. So take all that to mean if the Fed is going to keep rates lower, okay, and right now the 10-year Treasury note is right around 0.70. 0.70 guaranteed from the U.S. government in a 10-year Treasury note. We talked about this in a prior episode about growth versus income investing. Follow me?
Yep.
Okay, you can get a 30-year Treasury bond from the U.S. government, and it'll pay you 1.5% per year guaranteed for the next 30 years. How does that sound?
Not bad at all.
It's not bad at all. I'm going to sell them all to you, right? So what that means with the U.S. Treasury note, the 10-year at 0.72 means you put your money into a 10-year bond or a 10-year note. They're going to give you 0.72 back on your money. Not even 1% return, okay? We just talked about, stock market's up 5% or up 10%, or these stocks are up 82%, or this thing's going up, insane amounts. But you can put your money with the U.S. government, or let's call it, a bank, and you can get per year 0.72, okay? Or you can get a stock like AT&T at around $30 a share that has a 6% per year dividend. So if you believe that AT&T is going to stay in business and that the stock price is not going to plummet, then by investing in AT&T stock, you could get
6 times the money
per year. So on $100,000, that's $6,000 to help you live or do whatever. Versus that same $100,000 with the U.S. government, you'll get $720 per year. But the difference is it's guaranteed. So if that's going to stay lower longer and you then have time, well, heck, if the Fed's going to leave rates low, and that's what dictates the price of the treasuries, right? And this would go for CDs as well, or money in the bank. So if cash, quote unquote cash, is going to be, between 0 and, again, a 30-year bond 1.5%. So you put $100,000 with the government and lock it in for 30 years, kind of like your mortgage on a house.
Yeah.
They will pay you 1.5% per year guaranteed. It used to be 6% a year guaranteed back in the year 2000, right? So when you're retired and you need income to live on, right? You just want one of those $1 million 7 income streams that you have to have, right? If you want to, keep up with the other millionaires out there, you're not going to make the retirement you want on 0.72 or 1.72 versus 5% a year, 6%. In real estate, switching gears, they call it a cap, right? A 6 cap, an 8 cap. That's kind of the percent return you could get on your money per year. So the lower the rates are from the U.S. government or from the Federal Reserve, then the more you're going to take your money and go find something else to do with it. So whether it's in the stock market and hope for the ups and downs, or find something that just pays more interest than that 0.72 for 10 years.
I guess just to wrap that up, would you say that more people are going to be taking that chance then, and that the market is going to see a flood, not a flood, but a little bit more money being thrown in just because of something like that, the chance to make even more as opposed to the, sure, guaranteed, consistent 1%.
Right. Yes, absolutely. So that's the argument for why the market keeps going up. And if you're trading, there'll be moments of weakness and moments of strength. But yes, if we can find, again, the S&P 500 even has a dividend, and all the stocks add them up and divide by the 500, right around 2% per year. So if you can put your money in the S&P 500 and just look at the 100-year chart of that, or the 30-year chart of that, or the 10-year chart of that, compared to whatever else you're comparing it to, you basically can get more just by owning the basket of stocks in the S&P 500. And if you can deal with the ebb and flow of your, your principal. However, we don't think that it's that simple. You need to kind of, again, do your work, figure out what it is you're trying to accomplish. There is a strategy of investing for income. There's a strategy for investing for growth. There's a strategy for investing for preservation of capital. So if you are looking to not lose, you really can't do the S&P version or even pick, again, a stock like AT&T. You just have to be fully aware of what you're trying to accomplish. Last thing I'll say on that is, again, back to gold. Gold is up, approximately 27% on the year. It doesn't pay any dividend. So in an environment where gold is in vogue, or gold is a worthwhile investment, it will go up without paying any type of dividend. And there are certainly stocks in the same category. But if gold goes down, then you're losing money. You don't even have a dividend to offset it. So you really, again, need to have a diversified portfolio with whatever it is you're trying to accomplish. And again, seek professional advice and understand, all that is involved.
Well, safe to say it's going to be an interesting fall for not just financial reasons, but for many other reasons out there. We'll be keeping you updated on all of it. Dewey, as always, another great episode in the books. We'll keep monitoring everything moving forward. That'll do it for episode 15. Again, please continue to subscribe, download, share, rate all of it. Really enjoying what we're doing here on the What Do We Do podcast.
We're excited for the rest of the year. Let's see what happens. And as we always say, we're just getting started.
The opinions expressed in this program are for general information purposes only and are not intended to provide specific advice or recommendations for any individual or any specific security. It's only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risks and possible loss of principal capital. Please seek advice from a licensed professional.